Most of us think of debt as just borrowing money, but it's actually a powerful system that shapes our economy. When banks give out loans, they don't just lend what they have, they create new money and interest. That's how the system ensures money keeps flowing back to the banks, often making borrowers pay much more than they borrowed. We'll explore how loans, interest, and debt really work, and why understanding this system can completely change the way you see money. Today, we will talk about how debt, loans, and interest actually work. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding debt. Debt is one of the most misunderstood financial concepts. Most people think debt is simply money you owe, but it's actually a powerful financial tool that fuels personal finances, businesses, and even national economies. When individuals, companies, or governments borrow money, they are effectively accessing funds they don't currently have, allowing them to spend or invest now and repay later. This borrowed money can be used for purchasing a house, starting or expanding a business, funding education, or even for large-scale government projects. Properly managed debt can accelerate growth, create opportunities, and improve living standards. Mismanaged debt, however, can lead to financial stress, defaults, or bankruptcy. Understanding debt is the first step to using it wisely. It's not inherently bad. It's a tool whose effects depend on how it's used, how much is borrowed, and how responsibly it's managed over time. 2. How loans work. Loans are the most common form of debt. A loan is essentially a formal agreement where a lender provides money to a borrower, and the borrower agrees to repay it over time, usually with interest. Banks and financial institutions lend money for various purposes: mortgages for homes, student loans for education, personal loans for consumption, and business loans for investment. Interestingly, banks don't always lend existing money. They often create new money digitally when a loan is approved. The borrower receives the funds in their account and can spend them immediately. This process injects new money into the economy, stimulating growth. The loan repayment process gradually returns money to the bank, sometimes with interest, completing the cycle. Understanding loans helps you see how money flows through the economy, why debt is crucial, and how it impacts both individual finances and broader economic activity. 3. The role of interest. Interest is the extra amount paid in addition to the borrowed principal. It is essentially the cost of borrowing money. For banks and lenders, interest compensates for risk, inflation, and the opportunity cost of lending money instead of using it elsewhere. The rate of interest depends on multiple factors: central bank policies, inflation levels, creditworthiness of the borrower, and market demand. Interest also shapes borrower behavior. High interest rates discourage borrowing, while low rates encourage it. For borrowers, understanding interest is crucial because it determines the total cost of a loan. Over time, interest payments can exceed the original principal, making debt expensive if not managed properly. On the flip side, interest drives economic activity because borrowers must earn or generate money to repay loans, fueling spending, investment, and production. 4. Principal versus interest. It's important to distinguish between the principal and interest on a loan. The principal is the original amount borrowed, while interest is the cost charged for borrowing that amount. In many loans, especially long-term ones like mortgages, early payments mostly cover interest, with only a small portion reducing the principal. Over time, as the principal decreases, more of each payment goes toward reducing the principal. Understanding this concept allows borrowers to strategize repayments, reduce unnecessary interest payments, and plan financially for the long term. By focusing on the principal and making extra payments when possible, borrowers can shorten the loan term and save a significant amount of money in interest. This knowledge is essential for using debt wisely rather than being trapped in it. 5. How loans create money. One of the least understood aspects of loans is how they actually create money. When a bank approves a loan, it doesn't take funds from existing deposits. It creates a new deposit in the borrower's account. This new money can be spent immediately, increasing the total money circulating in the economy. This system, called fractional reserve banking, allows banks to multiply the money supply far beyond the physical cash in circulation. As loans are repaid, money is removed from circulation, balancing the system. This means that debt isn't just a personal financial tool. It is the backbone of the modern economy, responsible for most of the money that exists. Understanding this hidden mechanism shows how debt drives economic growth, while also highlighting the importance of responsible borrowing and lending. 6. Different types of loans. Loans come in many forms, each serving a specific purpose. Mortgages help individuals buy homes. Personal loans finance daily needs or emergencies. Student loans support education, and business loans fund companies' growth and expansion. Credit cards and lines of credit are revolving loans, allowing borrowers to spend, repay, and borrow again. Each type of loan comes with its own interest rates, repayment terms, and risks. Choosing the right loan requires evaluating your financial situation, goals, and ability to repay. Misusing loans, such as borrowing more than you can handle or choosing high-interest options, can lead to financial trouble. Understanding the differences between loan types empowers you to borrow strategically, minimize costs, and use debt as a tool for growth rather than a burden. 7. Risks of debt. While debt can be a powerful financial tool, it carries inherent risks. Borrowing beyond your repayment capacity can lead to missed payments, rising interest costs, stress, and even bankruptcy. High-interest loans, especially payday loans or unplanned credit card debt, can grow faster than your ability to repay, creating a vicious cycle. Businesses may over-leverage, leading to insolvency or closure. Governments can also face economic instability when public debt grows uncontrollably. Understanding these risks helps individuals and organizations make informed borrowing decisions, avoid excessive debt, and plan for contingencies. Responsible debt management, budgeting, and awareness of repayment. Obligations are essential to harness debt positively while minimizing potential negative impacts. 8. How debt drives the economy. Debt isn't just a personal or corporate tool. It is a critical engine for the entire economy. Borrowing allows businesses to invest, expand operations, and hire more employees. Consumers can buy homes, cars, and other goods, stimulating demand. Governments borrow to fund infrastructure, education, healthcare, and other public services. This constant flow of borrowing, spending, and repayment keeps money circulating, fuels economic growth, and drives job creation. Without debt, economic growth would slow significantly, as capital for investments and purchases would be limited. 9. Strategies for managing debt. Repaying debt strategically is crucial to avoid unnecessary interest costs and financial stress. Effective strategies include paying more than the minimum monthly payment, prioritizing high-interest loans, consolidating multiple debts, and refinancing when interest rates are favorable. Monitoring repayment schedules, understanding how interest accumulates, and planning extra payments toward the principal can reduce overall costs and shorten loan duration. Early repayment can save significant interest but sometimes carries penalties, so it's important to review loan terms. Financial literacy and careful planning empower borrowers to navigate debt responsibly, maintain good credit, and use loans as a growth tool rather than a financial trap. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.